I've been asked to talk about climate finance as a particular example of international public finance. And I want to just offer some reflections on where I think we are now with climate finance. It's a relatively new field, but it's one in which reality on the ground is now diverging very strongly from the political discussions and debates and negotiations around climate finance. And I think this is of concern, but is also very interesting when we place it in the wider context of development finance. So just briefly to explain what I mean, the concept of climate finance and the distinction that was been classically made, as in the rest of the climate field, between climate mitigation, that is the reduction of greenhouse gas emissions, and adaptation to the climate change which is already occurring and which is projected to occur, was classically thought of originally when the concept arose as the payments that were required for developing countries, largely from developed countries, as in some sense the compensation for the effects of climate change which were occurring in developing countries, which had been caused by developed ones historically, and was seen as the extra costs that developing countries had to bear over their existing development costs because of climate change. So in adaptation, that was the extra costs that countries had to bear because there were more extreme weather events, coastal surges, and so on, because temperatures were rising, aridity, water supplies were changing. And there was an incremental cost of climate change on top of the existing development cost. Similarly, in mitigation, it was assumed that countries would undertake under pre-climate change circumstances a path of development which largely, for example, used fossil fuels. And if they were to mitigate climate change by shifting towards lower carbon sources of energy, those would be more expensive, and therefore there was an incremental cost of mitigating on top of a base cost of development. It very quickly became clear, once people actually started to try to define adaptation expenditure, that the idea of a base cost, of a baseline, and then an incremental cost of adaptation was incredibly difficult to define. That in practice what needed to happen, for example, in agriculture, was different forms of agriculture in response to changing weather conditions, and not just some long-term future-proofing, but proofing against changing weather conditions now. And of course, for a few years, you could have imagined what the world would have been if the temperatures weren't rising and if water supplies and aridity weren't changing. But now it's more or less impossible to think of what that baseline is, because we are now experiencing climate change. And therefore, the concept of an incremental adaptation cost become more and more difficult. It become more and more difficult conceptually because we're looking at integrating the adaptation into the core activity, into the agricultural activity, into water management and so on. And it's less and less obvious what the baseline is that we should be operating with of some world in which climate change wasn't occurring. And so that's become pretty obvious in adaptation, in which there isn't really a separate field of adaptation, except in the important but limited area of disaster risk reduction, where there is a degree of we can show the additional costs that are needed, for example, in sea defences or in flood defences. So that area still is reasonably well defined. But much of other adaptation expenditure, making infrastructure, agriculture, water management and so on more resilient to the climate change which is already occurring, is very difficult to define. That still, however, seemed to leave the field of mitigation open to the incremental cost view. But that's also, in reality, become more and more difficult to separate out the base cost from the extra mitigation cost, which in particular is what international development finance was meant to cover. And that's because, for two reasons. One is that the costs of renewable energies, for example, have fallen dramatically against fossil fuels, and in many countries they are now close to the same cost or require only a little bit of extra subsidy. But secondly, and even more interestingly, the other benefits that you get from moving towards a lower carbon development path have begun to emerge very strongly. And it's unclear that you can say that if climate change, if mitigation didn't have to happen, a developing country should go on a high carbon path. And it's only because of climate change that you want to move towards a lower carbon development path. The most obvious example of this occurs with air pollution, where many countries, of which China is the most famous one, but this is now true in many countries, want to move towards lower carbon forms of energy supply and transport and in industry, not just and not primarily because of the climate cost, but because of the air pollution cost of those forms. And therefore, this is not just a climate question, it's a question of development, which does not therefore give you the simple rationale for the incremental cost of shifting towards a lower carbon path. Another example which is emerging even more clearly now, but this is later, is in urban development, where the model of urban development that many countries have, which is of sprawling, rather unstructured development taking up a huge amount of land area, based on car travel, is not a good development model. It produces very poor health outcomes, social outcomes. It creates divided, unequal communities. People are unable to be mobile. And that the best way of developing is to move towards a more compact urban form based on public transport, which is good for air quality, road accidents and health and safety, quality of life, the competitiveness of your city in attracting talent, and also climate change. But climate, frankly, is the co-benefit of all those other things. So what you have here is that the fundamental model of climate finance, in which there was an incremental cost to be provided by international climate finance on top of a baseline of development which would occur otherwise, is simply breaking down. And this is breaking down in all kinds of countries. So it's not just in middle-income countries where this is breaking down. So it used to be thought that adaptation was basically something which would be applied to least developed countries, and the only countries in which it was worth doing mitigation were the middle-income countries, because they were the only ones who were emitting enough carbon to be worth mitigating. But that's not, in fact, the way in which the world is moving. There are many of the least developed countries, particularly in Africa, who now see low-carbon energy as a better form of energy supply than the high-carbon forms. Partly for energy security reasons, partly because imported oil has a terrible impact on balance of payments, and partly because they are filled with abundant renewable energy resources, not just solar and wind, but geothermal in many countries, and those look like good development paths. So although the total amount of mitigation that you would get in a very poor African country is very small, they still want, there are many countries which are now shifting towards lower carbon development paths in energy, in urban development, and in deforestation and land use, where again controlling deforestation and restoring degraded land is not just a climate mitigation activity. It's a fundamental activity to preserve weather systems, which are related to forests, to preserve natural environments, to retain soil and water, and so on. So the fundamental model of climate finance, which we used to have, no longer accords with the reality on the ground, in which climate change is now being much more integrated into development planning, in all the fields in which originally it was thought of as an incremental cost, and it's one in which more and more countries right across the income scales are interested. This, of course, is not where climate finance politics is. Climate finance politics separates out development finance from climate finance completely. There are two completely separate negotiating processes around the SDGs and around the climate negotiations. The climate negotiations are fixated on a specific number, which is the 100 billion, which was defined completely out of thin air in 2009 as a compromise. I can tell you, because I was partly responsible for the thin air. I still have the envelope on the back of which we worked out in the British government why 100 billion would be a suitable number. And it was very suitable. It managed to get a deal where before the developing countries were on 300 or 400 billion and the US was on 20. But the 100 billion was an arbitrary number which was generated in order to reach a political compromise in Copenhagen, and which succeeded in doing so in the sense that there was agreement around it. But it was public and private with no definition either of how much should be public and how much should be private, or what the private bit actually meant, since it was a demand on developed countries to mobilize the sum of money, not merely an amount of money that had to flow. And of course the actual flows into into climate-related activities of much, much more than 100 billion already. So we're fixated on a number by 2020, which is very difficult to define. We're fixated also on the institutions that should deliver it. So the Green Climate Fund, which is the institution of the COP, of the climate change institution under the UNFCCC, is by far the most important element of the politics of this, even though its total capitalization will be only around 10 billion, if we're lucky, and considerably more will continue to flow through the IFIs and through bilateral aid programs, through UN agencies, and so on. And so the politics of climate finance are now not really related to the reality on the ground and the way in which countries are thinking about the development processes at all. What we must hope is that we have another year or so of the politics. But then once a new settlement has been agreed, both through the SDG process and through the Paris Agreement on climate change, we can begin to think more in a much more integrated way about the way in which climate relates to development and to growth. And the really interesting stories here are arising. You may have heard of the new climate economy report, which was published by the Global Commission on the Economy and Climate a couple of months ago, in which the growth, in which it is shown how a low carbon and climate resilient form of growth is a strongly beneficial growth path for most countries. And then we need to think of climate finance in the much wider context in which, Gail, you were talking about it seems to me. And there are some good things happening in this field. And just to finish, one of the interesting developments, I think, in this is that climate finance has been subjected to probably, I was going to say more innovation. I probably shouldn't do that because I'm not exactly sure of all the comparators. But there's been a great deal of innovation in the way people have thought about how to use climate finance. So, for example, payment for results is a strong move within the climate finance field. Started out in forestry, where, for mitigation purposes, the developed countries, particularly Norway, which has put a lot of money, was determined that its funds should be used actually to reduce deforestation in a measurable form, and said actually we should be measuring this, and we can do that now with satellite technology. So you've got a very strong payment for results framework beginning to emerge in forestry, which is that you can measure the amount of the reduced rates of deforestation per dollar of finance put in. And now people are beginning to say, well, let's do that with renewable energy as well. Let's measure the gigawatts of renewable energy that we're buying with the finance and the difference between the emissions that result from that and over a baseline case of using fossil fuels. And you can see that occurring in other areas as well. Secondly, you've got an extraordinary innovation in the institutions now doing climate finance, because some of the most interesting work is being done by development banks, and not just the multilateral development banks, or rather not just the Western governed multilateral development bank, the World Bank, and so on, but the new development banks that are the national development banks, and some of this is South-South, so BNDES from Brazil is beginning to be very active in other countries. The China Development Bank, both BNDES and China Development Bank, much, much bigger than the World Bank, are now very active in this field. And of course, we've now got two new development banks, basically public development finance, but largely South-South development finance, operating on a sort of semi-private way, but nevertheless using public funds. The Asian Infrastructure Development Bank, which is just Asian Infrastructure Bank, and the new BRICS Bank, the new development bank, which have not yet come into operation, but which will actually be larger sources of climate finance in this wider sphere than many of the existing institutions. Thirdly, you've got very interesting developments now in the around weather and disasters, catastrophe bonds, new insurance schemes and so on, which are beginning to provide finance and using the risk appetite of private markets to generate funds that would be available in the event of weather disasters. You've got a huge range of innovations, still all very small, but nevertheless very interesting, on using public funds to leverage private funds, particularly into energy, where the presence of public funds can do this sometimes of its own accord, but also specific instruments of risk mitigation instruments beginning to be used to leverage private finance. And you've also got innovation on the recipient side, with a number of countries setting up climate funds specifically to act as a channel for all the incoming development finance to try and then use those in a coordinated way for low carbon and climate resilient development. And that seems to be interesting as well. So my take on this field field is that this is a very interesting example of the kinds of developments in international public finance that have been talked about here, but that the politics of this hasn't caught up. And what we need to try and ensure is that at least the politics then, once we resolve the negotiations over how much we should be allowing, that some of these innovations that are now occurring in this much more integrated sense of what low carbon and climate resilient development and growth mean should be applied in the ways we use those funds.
Thank you very much.